What's up, everybody? My name is Keena, and this channel covers personal finance and investing. Many of us believe that we can't outsmart the big institutional investors and hedge funds. You know, BlackRock, Citadel, Melvin Capital, and the like. That's just common sense, right? Well, maybe not. Over the past 6 months, we've seen collective actions taken by the Wall Street Bets Reddit community make a crack in the armor of hedge funds, demonstrating that it is possible to interfere with the big guys and cause losses. But in the case of GameStop and meme stocks, it's taken a village to do so. But what about outplaying the big guys at their own game? While it might be fun to push back on institutions, my interest is focused on gaining an upper hand and increasing personal returns. The big secret of the investing world, and I'm not even sure why this is a secret, but it's that the little guy has a significant advantage when it comes to buying and selling securities in the open market. This video is going to outline exactly how to outsmart institutions and increase personal returns. My approach doesn't require buy-in from an entire Reddit community or sophisticated trading tools or anything that's out of reach for the average person. Let's start the video. Come along for the ride. Let's talk about the major thing that small investors can do that large institutions cannot, and that is move quickly and react fast to changing markets. I'll discuss why retail investors can move so quickly, and then how you can use this to your advantage. But first, I want to start by addressing an age-old question. Why do stocks go up, and why do they go down? No, this isn't a joke. But if you ask people on the street, or even the financial professionals, you'll get a lot of answers like, hey, interest rates are going up, or Q1 earnings were lower than expected, or a new CEO was hired. But the truth is, that's all Now, hold on. I know what you might be thinking. But this is not actually as crazy as it sounds. There's only one single root cause explanation for the movements of stock prices. Stocks go up when people are clamoring to buy. That is, when demand is outpacing supply. And they go down when people are fearful and anxious to sell. Any other explanation is a half-truth. So while it might not be incorrect to say that lower than expected earnings caused the stock price to fall, it doesn't cut to the heart of the issue. And more importantly, it doesn't give us much leverage to increase our investment returns. So you might be asking yourself, how does focusing directly on the buying and selling activity that happens on an exchange give us leverage to increase personal returns? And how does all of this relate to small retail traders and our ability to move quickly in and out of markets? Consider that over 80% of trading volume in the stock market is controlled by fund managers and institutions, and that the average trade size on the New York Stock Exchange is something like 200 shares. So when you or I buy a security, it's a drop in the bucket compared to the total trading volume for that day, and it has absolutely zero impact on price levels. On the flip side, when you're a large institution with millions or billions of dollars to invest, the simple act of taking a position in a company will cause the price to move up. And conversely, when a large institution divests from a given security, the act of selling floods the market with excess supply, thereby driving the price down. Imagine selling out of a stock and watching the price fall as each successive block of shares is sold. To illustrate this, let's take the hypothetical example of Cathie Wood's ARK Innovation Exchange Traded Fund, which trades under ticker symbol ARKK and contains $2.5 billion of Tesla stock. Cathie also holds Tesla in 2 of her other funds, bringing her total holdings closer to $3.5 billion. If we consider that the Tesla market cap is about $650 billion, then $3.5 billion in holdings amounts to about 0.5%. And if ARK Invest decided one day to dump all of their shares, you might expect the stock price to immediately fall by 0.5%, or say $40. But that figure assumes that the market is rational, which it most certainly is not, at least in the short run. You see, institutional sell-offs often cause panic in the market, causing a cascade of selling activity as one group pushes another group to follow suit, and as buyers realize that they can make lowball offers and have them be accepted, resulting in a mass exodus. A good analogy for the behavior of markets would be when a fire breaks out in a movie theater. The first few people that notice the smoke are easily able to find the exits and leave. In this example, the big institutions are in the theater with their entire family, including kids and elderly grandparents, so when the alarm does sound and everyone is fighting to reach the exit, it becomes very difficult for them to get everybody out of the theater unscathed. In this scenario, retail investors are sitting in the movie theater alone. And if we are able to notice those warning signs, we can quickly exit the theater before the mass panic erupts. This works the opposite way too. We can look for signs that a popular movie is going to play next in a given theater and quickly enter, take our seats, and enjoy the returns. The fact that institutional investors cannot move fast is their Achilles heel. In order to not cause undue panic when selling, they typically exit positions over extended periods of time, consisting of many weeks of slow and steady selling. Similarly, to avoid pushing the price up too quickly, institutions will buy in slowly. Think about how quickly a jet ski can change directions versus how long it takes for, say, a large container ship to change its course. In addition to slow buying or selling, another strategy that big investors use is making trades in dark pools, which disguise who's making the trade until after the transactions are complete, thereby keeping the price from dropping as far as it would if they were just selling out in the open. Warren Buffett summarizes the challenges faced by large investors in his 2004 Berkshire Hathaway annual report to shareholders, saying that, quote, "Our huge positions add to the difficulty of our nimbly dancing in and out of holdings as valuations swing." As small investors, we need to know what warning signs to look for so that we can quickly move in and out of the market at the right time. By looking directly at buying and selling activity on an exchange, we can see the early signals that big money might be moving into the stock, which is a signal that we might want to buy, or out of the stock, which is a signal that we might want to sell. Two assumptions up front. The first is that you've chosen a publicly traded company that you believe in, and that you've conducted a fundamental analysis to determine whether this company is likely to have a sustained competitive advantage into the future. All of this is out of scope for this video. I know finance videos can be a bit dry, and I already know this one's probably going to be on the longer side, so I'm trying to keep it short. But basically, we need to be looking at a high conviction company, one that we think will outperform the average in the long run. The second assumption is that you plan to buy and hold in the longer term. Personally, I don't believe that technical analysis works well for short-term day trading, but I'm sure there's a lot of folks out there who would disagree with me. I know that at this point in the video, there's a good chance that people might start zoning out. So let's start with an embarrassing clip of my friends and I in high school driving around and genuinely just looking like idiots.
I got the rhythm in my feet.
Okay, hopefully that got your attention. If you thought that was funny, and hey, if you're getting value from this video or any of my videos, all I ask is that you just smash that like button. I put literally dozens of hours into each video, and it really means a lot when you do that. One more note before we jump in. I'm not a financial advisor, and taking advice from me or from anybody on YouTube is probably not the best approach, so I suggest you consult a CPA before making any decisions regarding your financial situation. And with that said, let's touch on two technical indicators that you can use to see when institutions and big players are moving money in and out of a given stock. Remember that stocks only go up because more money is wanting to buy than sell, and they only go down because more money is interested in selling than buying. Institutions are moving so much money that their actions directly drive the stock price, and it often takes weeks to buy in or sell out of positions. So our goal is to catch them in the act and do what they can't: respond quickly. The first tool we're going to look at is called the MACD, which stands for Moving Average Convergence Divergence. This is a trend following and momentum indicator that compares the average price changes of a stock over time. You can think of this tool as the gauge on a fire hose, and when the pressure gauge is moving up, somebody big is pushing money into a stock, and if it goes down, somebody's taking a lot of money out of the stock. Let me grab my laptop to give you a quick example. I know this can be overwhelming at first, but with a little practice reading the signals, it really can become second nature. Okay, so we're going to be looking at AMD, a semiconductor company that happens to be a very high conviction stock for me personally. At the top of the frame are candlesticks set at the 1-day interval, going back about 6 months. If this is new to you, there's dozens of videos out there to explain candlestick charts. I'd be happy to make one as well. Just drop a comment below to tell me that would be useful. Basically, we can see the price of the stock oscillating between around $100 per share in January, all the way down to around $72 in May. Now, I'm going to enable the MACD indicator, and we can see it show up at the bottom of the frame. The orange line is the MACD line itself, and the blue line is the signal line. The orange line is determined by taking a long-term average price. In this case, I'm looking at an average price over the last 21 days, and subtracting a shorter-term average price. In this case, I'm looking at 8 days. The blue line is called the signal line, and it's just a 5-day moving average of the price. Now, do you see the places where the orange line dips below the blue line? This is a possible indication that a bear market is taking hold. and the price could continue to fall. So we might want to exit the stock, or the movie theater in that example. And see where the orange line crosses above the blue line? This indicates that it might be a smart time to buy in. Now, let me add in one more technical indicator. This is called the stochastic indicator, and it compares the closing price of the stock against a range of its price in recent history. The basic idea is that the momentum or speed of the stock price changes before the price itself changes. Think about a rocket ship going up into the air. Before it can turn around and come back to Earth, it has to slow down. So the momentum will always slow before the price actually changes. And if we can notice this slowing, we can decide if we want to take action before any price shifts start to occur. Here with AMD, we can see that right now there's been a lot of upward momentum recently, suggesting that a pullback might be on the horizon. If we're trying to time our market entry, this is probably not the best time to buy in. But if we go back to mid-May, we can see that the downward momentum had hit a low, suggesting that was a good time to get on board. All right, folks, I'm not going to dive any deeper into technical indicators here. It's not always going to be possible to catch the downtrends. Sometimes crazy circumstances hit us. For example, the COVID pandemic came on so quickly that very few of us were able to react fast enough to avoid losses, or at least temporary losses. And in those circumstances, you just kind of have no choice but to hold until the recovery is complete. And this is why buying companies with strong fundamentals that can be resilient and surge back after a downturn is so important. That being said, I hope this video has given you a better understanding of the challenges that big institutional investors face and has incepted in your mind the idea that it's possible to use technical tools to detect when big changes are about to take place, giving you some time to decide what your next move should be. By combining these technical tools with a solid fundamental analysis of each company that you buy, it is entirely possible to beat the average return of the S&P 500. Contrary to popular belief, 15 to 20% average annual returns are entirely possible for average retail investors, and the only reason that mutual and hedge fund managers underperform the S&P 500 average is because they just don't look at the long term. They're generally obsessed with increasing their assets under management, and the best way to achieve that goal is to create gains in the short term. And when you focus too much on the short term, you generally underperform. Anyways, that's it for this one. I packed more information into this video than normal. I suggest rewatching to catch any bits that you might have missed. If this video was valuable to you, smash the like button and the subscribe button. And if you're so inclined, hit the bell icon so that you know when I post new videos. Thank you, and I'll see you all in the next one.